What's up? The Fed is cutting rates again, and for most people that's either confusing or boring, but it shouldn't be, because this decision will affect your paycheck, loans, and savings. And it could also open the door to real profit if you act really fast. Before I let you know the strategies, please make sure you hit that subscribe button so you don't miss any market updates. And before we go diving into specific strategies, let's quickly recap what rates actually mean in this context. When we talk about the Fed cutting rates, we mean the federal funds rate, essentially the interest rate that banks use to lend to each other overnight. When this rate goes down, banks can borrow money more cheaply, and they often pass those savings to us, the consumers, through loans or credit cards. Cheaper loans can stimulate buying homes or cars, etc., anything you want to buy, and also business people to have investments. However, there is a downside. Rate cuts usually happen when the economy is slowing down. In other words, if the Fed is cutting rates, it's often because they see warning signs in the economy like rising unemployment or financial stress and want to stimulate growth. We are in an economy that's about to fall if the Fed doesn't step in. But the real question here is, how can you make money from this? I have 3 different strategies that you can follow. Take out loans. If you need a loan for a car, college, personal use, or home, consider acting while rates are falling. Lower rates mean lower borrowing costs for you. By locking in a loan at today's reduced rates, you'll pay less interest over time, and then you save potentially thousands of dollars over the life of the loan. This is especially true for big loans like mortgages, but it can also help smaller loans too. Let's say you're looking at a $20,000 car loan. If you wait, that loan interest rate might drop further, but it could also rise if the economic conditions change. By locking in a low rate, you are ensuring that you'll benefit from the current cut, and you can also do that if you refinance. But how much money can you actually save by doing this? For instance, a 25 basis point drop on a $35,000 auto loan only lowers the payment by about $4 per month. However, those savings add up over time. And if you compound those through multiple cuts or larger loans, the benefit will grow. But for a larger loan like a mortgage, let's say, the same 25 basis point drop could save roughly $80 per month on a $500,000 home loan. The key point is to know that grabbing this opportunity to refinance or borrow when rates are low is really interesting and really useful for you too. Even if the monthly savings seem modest, you're effectively putting that free money back into your pocket each month instead of paying it to the bank as interest. Now, the second strategy is to invest in assets that win when rates are dropping. What are those? Those are stocks or crypto. Certain parts of the market tend to do well when the rates fall. In the stock market, we're especially talking about tech and consumer stocks. When we have lower borrowing costs, it makes it cheaper for these businesses to expand, to invest, and hire more people. Companies that rely on growth, like let's say tech firms, consumer discretionary companies, etc., they often get a boost. Historically, as long as the economy avoids a recession, equities respond well to falling rates. For example, when the Fed delivered a surprise 50 basis point cut in September of 2024, the first cut in years they had, the S&P 500 initially hesitated, but then surged by 1.7% the next day to new highs. Investors cheered the return of easy money. Similarly, during the Fed's quarter point cut in September of 2025, the Dow Jones Industrial Average hit an intraday record high of over 46,000. That's the same day, though, that the S&P 500 ended flat, because the news, they were largely expected. That's just so you know. The lesson is that rate-sensitive equities, think growth stocks like tech or anything that benefits from cheaper loans, can climb when rates drop. In fact, many of these big tech names like the so-called Magnificent Seven continued setting record highs since 2023 till right now, as rate hikes have stopped and we have begun with these cuts. Now, secondly, crypto. Crypto is a really risky asset, and it loves easy money. When rates are low, liquidity flows into assets like Bitcoin, and we saw this in action around recent Fed moves. Before the Fed's September 2024 half-point cut, Bitcoin surged by about 5% in anticipation. briefly hitting that 61,000 mark, its highest in 3 weeks at that time. But why? Because they speculated that lower rates would boost liquidity and drive some money into crypto. A similar pattern actually occurred in 2023. As soon as the market believed that the Fed was going to be done hiking, Bitcoin and other cryptocurrencies had this enormous surge. By late 2025, Bitcoin was surpassing the $100,000 benchmark. So you can say that being an investor when rates are dropping can pay off. History shows that 1 year after the start of most Fed easing cycles, the stock market is usually higher. Rate cuts are like fertilizer for markets, I would say. They're not a guarantee of growth, but they create those conditions where growth is more likely to happen. But let's also not forget why these rates are happening. Why are we cutting? This is because the economy is in real trouble, people. This is not we're playing games. We are almost into a recession, and stocks could actually be volatile and even lower rates. Therefore, diversification is really, really important. The third strategy is to use prediction markets. Place your bets on the Fed moves. You and I don't get a vote on the Fed meeting. No, we don't. But we can get to place our bets on what the Fed will do thanks to prediction markets. One example is Polymarket, a platform where people bet on real world events. Essentially a decentralized betting market based on information and forecasts, not just pure luck. There are Polymarket questions on everything from will the Fed cut rates at the next meeting or who will be the next Fed chair. If you have insight or strong opinions on these outcomes, you can buy shares into a yes or no outcome and potentially profit from it if you're right. To illustrate right now, Polymarket traders are asking if the Fed rate will fall to 3.5 or lower by the end of 2026. And the odds of that were around 93% as of reflecting expectations that multiple cuts are likely through 2025 till 2026. On the flip side, the odds of a Fed increase in early 2025 is around 1% or less than 1%. Prediction markets don't stop at rates. They even let people speculate on personnel and policy changes. It's really, really interesting. There's a poly market on who will be the next Fed chair. Since traders are betting on the next scenario that Trump is going to choose, Kevin Hassett, a former economic advisor, is currently the front runner with about 78% probability that it will happen. Other names like Kevin Warsh or Chris Waller have single-digit odds, and the market even allows betting on no one by 2027. Very low odds. That is crazy, actually. I don't think we'll have Jerome Powell for that long, but if you follow these markets, you can see where expectations are moving. Warning, I am not saying you should throw your rent money into prediction markets or any sort of bet. These are effectively a form of trading, and you can win a lot of money, but you can also lose a lot of real money. Think of it as a tool for insight. Profit second. Often, just tracking the odds can be informative. For example, if Polymarket odds suddenly shift from 90% chance of a cut to 60%, it might signal a new information coming into people. Maybe a Fed official made a hawkish comment, or etc. In a way, it's like having an extra radar that keeps you informed. I am not a financial advisor. This is just an idea. These markets are based on information, but surprises can happen any day. Imagine betting on a 25 basis point cut, and the Fed does an emergency 50 basis point cuts, or hold steady. Your bet could lose even if your broader thesis was right. In conclusion, the Fed rate cuts might sound like wonky trivia to you, but they have real effects on you every day. Money decision. Rates down? That's your signal to consider borrowing or refinancing at cheaper rates, to look for investments that benefit from easier money, like stocks or crypto, and even to peek at what the crowd forecasts via prediction markets. None of these strategies are foolproof. Of course, I am not a financial advisor, as I said earlier, but these are strategies that you might be able to profit from. Always do your homework, but consider your risk tolerance. And listen, by understanding the ripple effects of this Fed policy, you can make moves to improve your finances instead of just watching the news pass by. If you found these insights really helpful, make sure you hit that subscribe button so you don't miss any of the future market tips. I am Sofía, and I'll see you next time.